Welcome. Today, we're going to talk about how to pay off your credit card without paying interest. Now, we are going to start by talking about how credit cards work. And obviously, generally, they charge some interest as you're paying them off. And so I'm going to start with the traditional ways, which will incur some interest. But we are going to get to hopefully the point where I am showing you a way to pay off that credit card debt over time and avoid the interest that credit cards generally charge. You got to stick with me to the end. We've got a lot of ground to cover in order to get there. And so I'm going to walk you through this as best I can because there are generally a lot of questions about this. It's not necessarily super intuitive. And so this is something where I think it behooves us to kind of see it, soak it in, reflect on it a little bit, and then ask any questions that you might have. And so this is one of those courses where the chat feature, where you can discuss with some of the other course participants, as well as me, I will definitely try to answer as many questions about this as possible. But hopefully this will give you a little bit of an overview on a different option for paying off your credit card, because a lot of people are trying to pay off credit card debt, and a lot of people aren't making as much progress as they could because of all the interest that gets charged. So let's go ahead and get into the topic today. Today, we are going to nerd out a little bit because it's going to be a little trip with the nerds to the nerdery. This is probably a little bit more detailed and technical than I would generally give, but I think it's important. I think it's interesting. And I think if nothing else, if you don't take anything away from this, as opposed to something like, hey, I'm going to use this. This is awesome. This makes a lot of sense. I just really want it to be food for thought. Unthink some of the thinking that we do sometimes. What are some of the things that we're doing? And are there some ways to turn it inside out? Think of it in a different way. It's answering the question about what if we could pay off debt quicker without having to figure out how to make more money and without having to cut our expenses. So essentially preserving our lifestyle, but yet pay the debt down faster. Would that be interesting to you? And for me, it was. And I always thought about this because of all the moving pieces that go into debt. Quick disclaimer here. Obviously, I'm going to be talking about credit cards. Not every credit card is the same. Prepaid credit cards are different. Some credit cards have their own terms. So we're going to be talking generalities. As far as I know, the information here is correct, but check to see if there's any specific things on the way they calculate or any of that stuff. So I won't be responsible for that, but just understand I'm talking at a very high level here, very strategically about this process. All right. And what will we be talking about today? Basically, the first thing I want to talk about is a little bit about why credit cards are challenging. I think we probably understand a lot of that. I want to talk to you about some of the go-to options that I use when people come in talking about credit card debt. Credit card debt is the number one issue for me when it comes to working with like financial coaching or counseling clients. This is usually the most common reason that someone engages with me. I want to talk about this strategy is key features, the process of paying down the credit card in this arrangement. What are the key features that make it unique? And then I want to peek behind the curtains here a little bit and explain why it reduces the amount of interest that we pay. Okay. There's the process, and it might seem a little convoluted and weird, but I will kind of show you a little bit of the math and kind of explain that so that we can start getting our head around why it does what it does. Credit card debt is a universal burden. This is why it's difficult. If we look at this chart, this is the growth chart for credit card debt for the individual over the past 5 years. Now, you can see from 2014 to 2019, it's continuing up. This is the individual credit card debt. I'm going to use the household credit card debt, which is a little higher at about $8,000 per household. But what we can see here is that people have credit card debt. They have thousands of dollars on credit card debt, and it's not going away. What are the challenges of paying off credit card debt? One of the big ones is that 76% of Americans live paycheck to paycheck, which means all of the money is accounted for. I've heard a lot of financial strategies about, hey, if you just saved $1 a day, that'd be $30 a month and a few $100s a year. Many people don't have an extra dollar a day. To think of having an extra $30 a month is a lot, especially when we're talking about credit card debt. Hey, if you just applied $10 more, $20 more, $30 more, well, that's just not an option for some people, if that makes sense. The other thing is, and I think a lot of these things we already know, is that credit cards have a high interest rate. On average, it's about 15% APR, and I've seen them as high as 29%. And depending on the different types of credit cards, it can be a little higher, kind of regulated usually by the state. But when you're starting with a lending instrument that is in the teens in terms of interest rates, it can just be hard to get ahead of it, to pay that down. And then the other thing here, minimum payment due is interesting because it tries to make the debt affordable. But on the other hand, sometimes people look at it as a guideline. Hey, I only have a minimum payment due of $100. Why don't I pay that? And what we know is that if you're paying the minimum on a credit card, we are going to really extend out the length of that credit card debt. So sometimes that minimum payment can be something of a trap and kind of trap people into paying that minimum, which obviously is probably not ideal. Now, addressing credit card debt, I'm going to speak to this a bit as a practitioner. I'm going to speak to it through my lens. So when people come in, and this is pretty common for me, they have $8,000 of credit card debt, average household credit card debt in America. And I have a checklist of things that generally I go through, not a literal checklist. I'm trying to explore some of the same things with people. The budget review, right? Do they have enough money coming in? Are they controlling where their money's going out? Do we have money to pay towards that credit card? I just want to get a picture of what their finances look like. Do they have an option to do a credit card transfer? This is something I usually don't bring up. They're usually bringing up. Oftentimes when people ask me about credit card debt, they're saying there's this other credit card and they have this introductory, no interest balance transfer offer for 6 months. And I'm applying to that and I'm waiting and I'm not sure if I'm going to get that. And so this is maybe something that you see too, and can take weeks, days, sometimes to find out. Those aren't necessarily always what they seem. The no interest is usually on new purchases. If you are transferring a balance, those usually will incur a fee of some sort, usually 1 or 2%. Sometimes they're not misleading, but sometimes people don't really totally understand them. And then usually, if you don't get to the end of it and have that balance paid off, there's some really high interest charges that get tacked on. How about the debt snowball? This is a common one. I've seen this presentation a lot, debt avalanche. There are ways to organize the debts, especially if you have multiple debts that give us a sense of kind of control over it, some kind of behavioral processes. And then debt consolidation, taking our existing loan, trying to find another loan, maybe a lower interest rate, consolidate that into one. These are all options that can be helpful for people. I'm not saying that they aren't, but what are the challenges of each of these? In the budget review, usually when people come to me, they have already modified their budget as much as they can. They've picked out the low-hanging fruit. They've cut the expenses out of their life that were weighing them down. They have tried to figure out where they can find extra money. They have done some work to their budget. And so sometimes it's not really easy. We look at the budget and I'm like, all the things that I think we should get rid of, cable TV, the gym membership, the subscription to Golf Digest, are already gone because they've already tried to take care of that. So sometimes there isn't really low-hanging fruit there. Credit card transfer. This is dependent on approval. And this is not just dependent on approval from the other company, but do you get that offer? Do you have a good enough credit history and credit score to get it? Do you have any available credit, right? Sometimes we're using all the credit that we should mathematically be allowed to get. So sometimes you'll get denied for this. So we have this dependency on it. The debt snowball. The debt snowball is focusing on the smallest debt first. It really focuses on how do we get organized? How do we get motivated? We start paying off the small debts and it's motivating to see that progress, but there's really no mathematical advantage of it. It's not going to pay off that debt sooner. I have no problems with it. I love it. And I've seen a lot of people be successful with it. But in debt consolidation, this is not really doing anything with the debt. It's just transforming it into another vehicle, something maybe with a lower payment, lower interest rate, something we can afford, but it's not giving us a lot of advantage. And especially if we're not doing debt consolidation on our own, if we're going to a debt consolidation company, like a debt management company, they may be adding their fees in. So again, it could be a great option for people just to get organized, to maybe get multiple loans into a single product. But again, we're not really transforming anything materially. Yeah, and the big thing is a lot of people, when they come into us, are looking for instant answers. This is urgent. This is important. Maybe they're falling behind. Maybe they're under a lot of stress. And so all of these things, what we can do is we can start them, but they usually don't result in anything that day. And so people are looking for something that they can sink their teeth in, maybe get started with immediately. And this process of paying down credit card debt is something that we can start right away. I call it interest amount optimization. And that's probably overly verbose for what it is, but I call it that because what we are not doing is we're not optimizing around the interest rate. We are trying to get the interest charged to us lower. So there are some things that you have to know about this, and I'll talk about them at the end too, because I think it's easy to say, all right, I see how this kind of works. And the key to this though is who is the right audience for this. So there are some things that you have to know about this, and I'll talk about them at the end too, because I think it's easy to say, all right, I see how this kind of works. And the key to this though is who is the right audience for this. And that is the people who are focused, responsible, and committed, because this is a process that requires some diligence and some dedication and organization. This is a behavioral process you'll have to stick to, but it does generate a mathematical advantage. By kind of reorganizing the steps here on the way we tackle our debt, we can gain a mathematical advantage to pay it down faster. Now, I'm going to use one major example here, tackling household credit card debt. And I don't want to go into a lot of specific examples. I thought about that, like different debt amounts. Basically, they're all the same in terms of the concept. And that's really what I want to try to across today. So you may say, hey, this credit card debt is too low. I see people much higher, much lower, whatever it is. I don't want to obsess too much about the individual numbers. I just want to use it as an example so that we can hopefully come to understand the concept by the end, because it can work to varying degrees with any of these numbers. All right. So what do we need to make this work? What are the prerequisites that need to be in place for them to take advantage of this? One, they have to have cash flow positive budget. They have to have money at the end of the month. They can't be underwater, because then we have other issues we got to solve first. We can't really tackle debt. We need to figure out how to get them cash flow positive so that there's money to apply to that debt. They are generally able to consistently pay the minimum or more. And I bring this up because if you can pay a lot more than the minimum, that's great. It's going to help a lot more. But if sometimes you are falling behind, sometimes you're not paying the minimum, sometimes you haven't paid the payment, again, we've got to look under the hood and fix some of the budget problems first. The other thing that we need is the ability to charge most or all of our expenses to the credit card. Now, in most cases, for a lot of us, we can charge most of our life expenses to the credit card. I would say that off the top of my head, if you have a car payment or something like that, or your housing, your rent payment or your mortgage payment often have to be paid out of cash or from your bank. In some cases, I've actually talked to some people who pay their rent through like a portal. They're like in a high rise and they log in and they can pay their rent through a credit card. It's going to vary a little bit. I don't want to obsess about that too much. If you have things that have to be paid out of cash, you have to adjust it a little bit on the income side, but I don't want to sweat that too much. I just want to talk about the concept. But the assumption here is that you can pay most of your expenses, groceries, gas, commuting, your cell phone bill, cable TV, all those things on your credit card. And for me, I do. I can think of only a couple things that I really pay in terms of bank transfers. And then again, self-control and constructive behavior is already in place. If that's not in place, we need to look under the hood and get that self-control in place first. Now, how do I try to determine if people have that constructive behavior in place? Here is a very simplified litmus test that I use. And it's really, where did the debt that we're trying to pay off come from? If it came from an unexpected one-time expense, like a medical expense, for example, I had a couple that was trying to pay off a credit card bill because they had a child that was sick and a lot of the treatment wasn't covered by insurance. And so they racked up some credit card debt because they paid off a hospital bill. So there were some things that probably should have been handled a little bit differently, but they were a prime candidate because this wasn't a shopping problem. This wasn't a behavioral spending problem. This was one time. It's probably not going to happen again. And so we could tackle it that way. Now, if you do have a lot of shopping history, of impulsive buying behaviors, again, those are sometimes things that, okay, we need to focus on that and just focus on the debt snowball, get organized on the side. But we really want to look at the root cause of why the debt is there, as opposed to how do we tackle that debt. We also have to have some prerequisite knowledge of credit cards here. And I think for most people, you will have this knowledge already, but I really want to just highlight it. And I want to dive a little deeper because these three pieces of a credit card are really important to understanding why this process works. So the first part of this is how credit cards are bidirectional in their nature. I'm going to talk about that. And then I'm going to explain a little bit on how the interest is calculated on a credit card. And then I want to explain how the grace periods work. Now, if you are a credit card user, it's going to be pretty familiar. So I'm not going to spend a lot of time on this, but I just want to highlight them because they are all key features. So bidirectional is probably most easily explained by comparing a loan to a line of credit. And a loan is anything that you apply for, you get cash, you make your purchase, and then you make payments along the way. A car loan, a mortgage is very much like this. And it's a one-way financial instrument. It's unidirectional in that if I want to send in my payment for my mortgage, I can do this. And usually there's no prepayment penalty. So I can send in more money towards my mortgage if I want. What I can't do is if I overpay on my mortgage one month and call my mortgage company and be like, listen, me and my guys wanted to go on a golf trip this weekend. I actually need $300 back. I overpaid last month, $300. Guess what? They're not going to do that. It's one way. The money goes in, it doesn't come back out. But in a line of credit, like a credit card, it's bidirectional. So if I have a $100 charge on a credit card and I send in $100 to pay off that credit card, and then I say, hey, you know what? I need a haircut for $15. Guess what? I can charge it to the credit card. I can send money in and I can borrow money against at will. So it's bidirectional. It's meant to do that. That's the point of a line of credit. And that's why they call it a line of credit as opposed to a loan. So that bidirectionality of a credit card is a good feature that we're going to take advantage of. And it's pretty obvious. Most people understand that. And then lastly, how the grace period works. And for a lot of us, if you are using your credit card and paying it off every month, getting your points, working up to that free Bose headphones or whatever it is in their incentive system, you're probably taking advantage of the grace period. And the grace period is simply the fact that your credit card allows you a window of time to charge things. So let's say week 1, 2, 3, and 4 on the slide here are January. So all of January, you can go, you can do your shopping, you can do your purchasing, you can do your grocery shopping, you can take your trips, all those charges. And then at the end of the month, they close it at your statement date. And so they freeze all those charges. They do a calculation and say, hey, this is everything that you charge. They put together a bill for you. You usually get that. Then you usually have a couple of weeks to pay it off, right? So typically about 3 weeks after the end of the statement period, you have to pay your bill. And if you pay off everything that you charged in January, you will pay no interest. So if we charge $1,000 in January, we get the statement and it's $1,000 balance, and I write a check for $1,000 or transfer $1,000 against it. Great. Credit card's happy. I'm happy. I get a grace period. So I get at least a few weeks of free, no interest loan. This is another effect that we're going to take advantage here. So I want to talk about the typical strategy of paying off a credit card. And so this is what I see with clients. They get a debt on their credit card. They get a balance on their credit card. It starts to become stressful. It starts to upset them. They come to a point where they decide, hey, I need to tackle this credit card debt. And so what they do is they freeze their credit card, maybe literally in their freezer, but usually it means just putting it away in the drawer. They're not going to use it. They're just going to try to pay it off as quickly as possible. Then they take all their income and they pay all their expenses. So they go to a cash system, and anything they have left over at the end of the month, they pay towards a credit card. This is the strategy that I see in most cases here. In what I'm calling the optimized strategy, that might be a little braggadocious here, but in what I call the optimized strategy is that we are going to thaw out that credit card because we're actually going to use it. The strategy actually only has really 2 components, and it's pretty straightforward if you think about it. One, we're going to apply all of our income as soon as we get it to the credit card. So a lot of people get paid every other Friday. So on Friday, you're going to apply all the income to your credit card. The following Friday, you're not going to get paid. The Friday after that, you will, and you apply all that to your credit card. The other portion of the strategy, part 2, is we're going to pay all of our expenses on the credit card as late as humanly possible. So if your cell phone bill is due on the 25th of the month, you're going to pay it on the 25th of the month. You're not going to pay it on the 24th or the 23rd. You're going to pay everything as late as humanly possible, right? All our cash goes towards the credit card. All expenses come on the credit card. And that is it. I'll tell you what, if you stop right there and just follow the process, you'll actually see the benefits that I'm going to go into next. So if you just trust that this works, and I'm saying don't trust me, trust what you can see and what you can understand. But if you just do this, I think you'll see some benefits. Now, why does this do anything for us? The big thing here is cash flow is key. And again, I'm going to use some general examples here. $70,000 is about the average household income in America. I'm going to take out some taxes, some benefits, health insurance, whatever it might be, and just say this household gets paid $2,500 every other week for a total of $5,000 in a month. So that means, hey, on the first payday, they get $2,500. On the second payday, they get $2,500. Let's just kind of keep it that simple. Cash flow, the fact that you're getting a lot of cash throughout the month is what is going to be the tool that keeps the interest charged to us down. Now, I do want to throw in a little caveat here because this is where it starts getting a little confusing. This does not reduce the interest rate. The interest rate stays the same. The interest rate is whatever it is by the credit card. What we're doing here is we're going to manipulate the formula for the interest that gets charged to us as much as possible with our cash flow. Okay, so let me explain why this does what it does. All right, so someone has an $8,000 credit card balance. They're pretty stressed out about it. They've frozen their credit card. They have $5,000 in income, and they have $4,600 a month in expenses. Okay, so at least their budget's in balance. There's surplus cash at the end of the month of $400. So what are they going to do? They're going to pay that $400 to the credit card. So now the credit card is going from $8,000 down by $400 plus the interest on a regular basis. And eventually they'll pay off that credit card, right? We'll eventually pay off that credit card. But in the optimized strategy, we're going to thaw out that credit card because we're going to use it. And that $8,000 credit card balance, now I'm going to take my $5,000 a month income and I'm going to apply it to the credit card. And then I'm going to charge my $4,600 costs to the credit card as well. Now, what you'll notice here is I have $5,000 going towards the credit card and I have $4,600 of expenses coming out of the credit card. The net effect to the credit card is still the same, $400 positive. So the credit card balance on a monthly basis should still be going down $400 plus the interest. So the advantage of this is that it seems a little convoluted, but we aren't paying any more or less to the credit card than we were before, if that makes sense. Okay. So I know we're getting into the nerdery part here, but net effect, we're not doing anything differently. We're just changing the arrangement of where the cash is flowing. And I bring this up because the average daily balance determines the interest that is charged to us. Okay. Well, so let me explain this visually. I'm a visual guy. Week 1, 2, 3, 4, this represents a month. And let's say we have an $8,000 credit card balance. We've frozen it. It's $8,000 in week 1, 2, 3, and 4. It's $8,000 all throughout the month. It's very easy to calculate the average daily balance. It's $8,000. And a 15% annual interest, that means that it's going to be $100 of interest charged at the end of the month. So we send in that $400 monthly payment. It reduces that balance from $8,000 to $7,600, but we tack on the interest charge so it goes back up to $7,700. Okay. So this is the typical way that most people pay it off. Now, let me illustrate what happens if we do it in this optimized way, right? So we're paying all our income again towards the credit card and we're charging all our expenses to the credit card. Okay. Same month. Now we're starting with $8,000, just like we were in the original way, but we get paid the following week, $2,500. So we apply that to our balance. Now the credit card balance goes down to $5,500. Following week is not a pay week. The week after that, though, is. So we get another $2,500 and we apply that. Now it goes from $5,500 to $3,000. But we still have $4,600 of expenses. So we charge all that and our credit card goes back up. We've started at $8,000 and we've ended the month at $7,600. So we are starting and ending in the same place we did like in the previous model. But now you can see here that the balance has gone down throughout the month. So instead of an $8,000 average daily balance, resulting in a $100 interest charge, we actually have a $5,250 average daily balance, which results in a $66 interest charge. Okay. So we get a benefit here of $34. We have reduced the amount of interest that's going to get charged to us by a third. That's effectively paying an additional $34 towards the credit card. It's money going directly towards the principal. And so it's money going directly towards principal that we didn't have to make. It's an extra $34 that we're getting towards that balance of the credit card that we didn't have to make. We didn't have to go out and earn. We didn't have to cut out of our budget. So by flowing the cash against the balance and bringing that average daily balance down, we are reducing the amount of interest that will effectively get charged to us. Okay. So hopefully that makes sense there. I'm going to explain a little bit more about that. $8,000 credit card, $5,000 income, $4,600 expenses. This is the scenario. I just want to now compare the traditional to the optimized model. In the traditional model, it's going to take us 2 years and we're going to pay almost $1,300 of interest. In the optimized model, we're going to pay this off in 17 months and only pay $867 in interest. Okay. So what's going to happen here is we're going to pay this off 7 months earlier than we would with the other strategy, with kind of the traditional strategy. Now, I bring this up because now you're going to have 7 months of no payments. All right. So that's one benefit. You're going to be free in January, February, March, April, May, so on and so on, of not making a payment towards a credit card. So that's going to be exciting in and of itself. But because this budget is $400 a month cash flow positive, that 7 months is going to equate to $2,800. At the same time, you would be paying off the credit card in the traditional model. At that same point in time, you will now have $2,800 in savings. So we don't want to assume that surplus money is being eliminated or anything like that. Bigger impact for people just getting by. I try to use a average example here. Most people aren't on average. Someone who came in struggling with credit card debt, she had $800 balance on her credit card. I have worked with people who didn't feel bad, actually felt like their credit card debt was in good control and they had $140,000 of it. Everyone's a little bit different. And so I thought I would just show maybe a situation you come across, people just getting by. Maybe they have a high credit card debt with a high interest rate and they have a lower income and they're able to make a smaller payment. So $10,000 credit card debt at 29% APR, maybe a $4,000 monthly income and $3,700 in expenses, which means that they're only paying $300 a month. So they're actually paying a smaller payment than the previous example with on a higher balance. So in this example, what does 1 month's interest look like? Traditional method of paying it down, $10,000 balance throughout the month. They send in $300 and so they reduce it, but that $10,000 balance results in $246 in interest, which means that of the $300 that they sent in, only $54 are actually going to pay down the debt. And this is why credit cards are really tough, because it can also be dejecting. People can give up sometimes because they say, hey, I sent in hundreds of dollars and my balance barely moved. You know, if you have a mortgage, like a 30-year mortgage, this is actually what happens in those early payments too. A lot of your payment just goes towards the interest. But in the optimized way here, even for this example, we started $10,000. After 1 week, they get paid $2,000. So it goes from $10,000 to $8,000. 2 weeks later, they get paid another $2,000. So it goes from $8,000 to $6,000. And then they charge all their expenses back. And so again, you start and you end at the same point. But now the average daily balance is $7,867, which means that the interest charges is $190. So now they're sending in $300 towards a credit card, and they're getting $110 of it applied to their principal. So instead of $54, $110. So we're paying down the principal twice as fast as we were in the traditional way. So this is why for high debt, low income people, they might actually get more value out of this because they are basically just paying interest in a lot of ways, especially if they're just paying the minimum. So in this example, let's just compare it. Traditional method, 5.75 years and $10,500 of interest. But if they pay it in this optimized manner, 4.4 years, and they'll pay $7,300 in interest. What they will do is they will pay this off in about a year and a third or 1.4 years earlier than they would have. That's a long time to not be making payments on a credit card, a year and 5 months. And again, $300 a month cash flow positive, which means at the same point in time that they would be paying off the credit card in the traditional model, they will have now $5,100 in savings. Okay, I'm oversimplifying a little bit, but that is a pretty dramatic difference, and a pretty dramatic difference in when we're going to get this debt paid off. Just to summarize, step one, we're going to apply all of our income towards our credit card immediately, and we are going to pay all of our expenses as late as humanly possible. The combination of the two is going to keep our average daily balance lower. And why that's so important is, one, it's going to reduce the amount of interest charge. It's going to make our payments towards the credit card more powerful. The same payment we're making, it's just going to put a bigger portion of it towards the principal. But the big thing about this is, like I said, I haven't talked about where we need to increase our income, where we need to decrease our expenses. This is something that we are just reorganizing what we already have. So we're preserving our lifestyle. Maybe people have cut to the bone. Maybe they're like, I can't do anything else differently. All right, then let's stop with trying to figure out around the periphery what we can do with our money. Let's just work with what we've got. And maybe they say, hey, I like my life. I do want to pay this down, but I want to balance it with everything else. Again, what we're doing here is we're preserving the lifestyle. We can find some other ways to supercharge this, but right now we're just using what we already have. Now, the best part about this is if you like what you've seen so far, there's more. All you have to do is pay separate shipping and handling. I've always wanted to say that because I always thought I'd have fun being a pitch man on an infomercial, but there is more. And remember when we talked about the three key pieces of the credit card, the grace period? So the other piece of this, the other kicker for you is that if you're using this, what we're going to do is we're going to restore the grace period on the credit card sooner. So we talked about this. In an ideal world, you're charging your expenses to a credit card. You get some free time to pay it off. In the traditional method here, let's say that you started with that $8,000 balance, that example, and now we're down to our last $5,000, right? So now we only have $5,000 balance. We still have our $5,000 monthly income. We're still making a $400 payment towards the credit card. What happens here is that we have about 15 months till we pay this off. But then in month 14, when we pay off the final balance, we actually get our grace period back. So now we actually can go back and use the credit card like we want to use it, right? Not to pay any interest. Now, what I want to show you here is that in the optimized model, and you don't have to schedule this, it'll just kind of happen eventually when you reach this threshold. But what I want to show you is that the balance is $5,000. But so is the monthly income. So in month one here, I have a $5,000 balance, but if I apply all my income to it, guess what? That balance is going to go to zero in month one. Okay. Now it's going to be temporary because we're going to have expenses to charge to it, but we're going to go back to zero. And so we're going to get the grace period back right away. Now I will caveat this because some credit cards require you to have 1, 2, or 3 consecutive billing cycles of zero balance in order to get the grace period back. But either way, now all of a sudden we're going to see our credit card balance going to zero. Now we still have $4,600 of expenses, which we're going to charge, but now our income outpaces the expenses. And so what we're going to do for the remainder of this is while we're back in the grace period is we're not going to have any interest charged to us, if that makes sense. So we're going to end up paying this off a month and a half sooner just because we don't have any interest being charged to us. We're using that grace period. What this means is, again, with that extra month and a half, we're going to have some surplus cash in month 13. We're going to have the full surplus cash in month 14. So again, we're going to be done a little earlier and we're going to be taking advantage of that grace period. So one, when we're flowing our cash towards the credit card, we're going to be decreasing the amount of interest that's charged to us to the point where we get back to the grace period, in which case that interest charge was coming down. And now we won't have any interest charged to us. Again, it might take us a couple billing periods to get that grace period back. But either way, it's nice to have the last 10, 11 months of no interest at all. This is what I call the relief ratio when our monthly cash flow equals our credit card balance. So if you have a $5,000 credit card balance, you have $5,000 monthly income, we can potentially get your grace period back right away, right? If this ratio is 1-to-1, then you might be able to get back to an interest-free arrangement on your credit card today, or very soon at least. So strategy summary here, you need to be cash flow positive. And if you are, we can put all of your income towards a credit card. We can charge all of your expenses against a credit card. We will lower the average daily balance. Eventually, we'll get to a threshold where we will restore the grace period on your credit card. And we can use that additional time to start saving again earlier. So we'll be done with the loan earlier. We'll start saving earlier too. So how do I do this? And I don't want to undersell. This isn't going to be a long section here, but this, I think, is the most important piece of this. How do we determine if that's even the right discussion to have? So one, we have to know their numbers. I think this requires us to do some budgeting, the budget review. It also requires us to look at those traditional methods of paying off debt first. The debt snowball is very powerful. I think for most people, for the majority of people, that's probably the right thing to do. And if it's not, if they want to get more detailed on it, they understand it, then we also want to model it. We want to see their interest rate, what's their balance, what's their cash flow. Is this something that's going to help them? And then monitor it. It's probably not something that you'll know 30 days later if it's making a big difference, but it's something that you probably want to touch base on a couple months later, 6 months later, whatever it might be. Is this working, or do we need to just move on to something else? And I bring this up because it's all about appropriateness. It's about suitability if you come from the financial planning world, right? Because this is a mousetrap. But if I am a human trying to trap mice, then it's a tool. But if I am a mouse, this is a trap. And so the same thing here can be very beneficial to one person and deadly to someone else. And I bring this up because there is a situation that I think that kind of scares me a little bit, is that if someone has an $8,000 credit card debt and they start putting thousands of dollars towards it, and they see that balance go down to $4,000, $5,000, they may be tempted to start charging. Wow, I never thought I'd be paying off my credit card this quickly. We're really not. Remember, we're starting at 8,000, we're going to 7,700 ultimately, but we've got these big swings in between. If that's going to be a temptation for people and they're going to start giving themselves permission to start spending in a way that their budget doesn't permit, this could be very dangerous. It could create more problems than it solves. So I want to bring that up. So again, how do you determine this? Again, to me, one of the ways is you look at what is the debt that we're trying to pay off. Where did that come from? And if it comes from shopping, if it comes from behavioral challenges, those types of things, then the person might be more apt for a coaching solution. But if it's a one-time expense, it's a wildfire that took out your home or a medical expense or something like that, then maybe it's appropriate for people. But I would say that for a lot of these people, for the vast majority of these people, I still think that they want the easy, understandable, bite-sized, manageable product like the debt snowball or the debt avalanche. Just get organized on it, build on their motivation, give them something that they can sink their teeth into, really own, get excited about. But for some people, that's not going to be enough, and they will be able to be cash flow positive and diligent and self-control and aware enough of how the process works. And so the interest optimization option could be right. But I would say that it's going to be for the vast minority of people. I would say that I have been working on this for about the past 2 years, and I have used the strategy with 3 people in total. So it's not something that applies to a lot of people, but it might be something that applies to some people and provides some really good value. And for the people that I have worked with, it can be definitely pretty dramatic. You can compound this effect with the traditional tactics. I didn't talk about all the normal things that we do to help pay down debt. Requesting a lower APR from your credit card company. You can certainly make that call. Finding some side hustles, bringing in some extra income, decreasing expenses. The other thing I didn't put in here too is maybe deploying some of that savings. Maybe we have an emergency fund that isn't being used, and yet we're getting charged high rates of interest on credit card debt. The effects on credit history. So we're going to bring that credit card balance down. We're going to lower the utilization rate. We're going to make sure we're getting these on-time payments because we're going to be sending a lot of money towards a credit card. So for people that are like really tight on making that minimum payment, you want to make sure you make that because otherwise it's a paid worse than expected. We're also going to preserve that credit card history. So that credit card isn't going to get canceled in a debt consolidation or debt management rule. We're not going to just continue to freeze it. Maybe get a letter that, hey, this card has been dormant, so we're going to reduce it or close it, those types of things. So we're going to preserve that long history on your credit report, especially if that's a card you've had forever. What are some of the other advantages? It's something that helps us avoid consolidation or management or bankruptcy or settlement, some of these other options. I'm not saying that you don't want to go after that. In fact, if you have some really high balances, these might be the best solutions. But we're not dependent on those things, and we don't have to go after them if we can get organized on the debt ourselves. There's no dependency, so I don't have to worry about that other credit card that I'm applying to get that balance transfer or debt consolidation loan or personal loan. And we are using math to our benefit, right? This process is convoluted. I'll use that word because it's not something that intuitively makes sense. We are doing it to get that mathematical advantage. The debt snowball is we're doing things to help motivate ourselves. And we're not changing the lifestyle. You can change the lifestyle and get even more traction on this. But right now, I'm just working within the confines of what a client has. And as I promised, I did put together a 1-page PDF with just the highlights here, the process, an example of what we're doing and why it works. And so just something to help remind you, especially if you're going to have this conversation or you want to dwell on this and think about it. This is available. This is a 1-page PDF. And then the second piece here that I have is an estimation tool. And this is a spreadsheet. And I debated whether or not to provide this, but I'm going to. But I'm going to throw in the disclaimer here that this is just an estimation tool. I just do this to try to get a handle on, is it going to make a difference or not? And what you can see here is it's just an Excel spreadsheet. You can put in the current credit card balance. You can put in the credit card interest rate, the total net income. So the net pay to you, the average monthly total expenses here. And in this line, you would not want to put in the payment to the credit card. What we're trying to do is we're trying to figure out the difference here, how much money would be applied to the credit card, because we're not really sending in a traditional payment, right? We're using the differential between how much we pay towards the credit card and how much we charge to it to net the payment. So if you are budgeting in your budget, hey, I send in $100 a month to the credit card, don't put that in the expenses. We'll leave that there. And then what you'll have here is an optimized pay down versus a standard pay down. And what you can see here is it's month 1 and 1.5. That's because in the optimized method, I'm assuming that we're getting paid twice a week. And then what it'll show you here is when it's the green, when will we pay off the final balance? And in this case, just for the screenshot here, shows that we pay off the balance in 7.5 months, and we would pay it in the traditional method in 13 months. We also show here that you might expect that you enter the grace period right before you pay off the final balance of the credit card in the traditional method. But you enter the grace period here after 2 months because now the income outstrips the balance, if that makes sense. So really, we're paying almost virtually no interest for the remainder of that, which is partially the reason why we get a head start. So this is also available, and I'm going to provide that. Again, that is not meant to be an exacting formula, just an estimator. It's something that is going to work, and you can fool around with some of the numbers there. But basically, what I wanted to do here is, again, unthink, rethink, think about just the confines that we have a lot when people are dealing with credit card debt. And is there a way to pay it off faster using a process? And so that's why I put this together. So for the audience that it's going to work on, it can be powerful for using the tools that we have to get done with credit card debt and break free from that debt sooner and start saving earlier as well. So that is it. So I thank you for suffering with me this last hour through the idea of interest amount optimization. Have a good one, everyone.